Hello everyone, welcome back to our CA Foundation Business Economics series where we are discussing business economic concept in the most quick and practical manner. So without wasting much time, let's get back to the video. So today we are covering chapter 9 international trade in which we will cover unit 4 exchange rate and its economic effects in this video. So here is a quick introduction. So exchange rates, the value of one currency in terms of another, plays a crucial role in global trade. Variation in these rates affect how much imports cost, how competitive exports are, and ultimately the broader economy. So understanding exchange rate types, their determination and effect helps in predicting economic outcome in the global environment. So what's exchange rate? Exchange rate refers to the price of one country's currency in terms of another. When a rupee strengthens against the dollar, it means fewer rupees are required to buy $1. So exchange rates are essential for comparing prices internationally and affect trade, investment and tourism. Here are exchange rate regimes. So first is floating exchange rates. So it is determined by market forces of supply and demand without government intervention. So example could be the US dollar fluctuates based on demand in the forex market. Then comes fixed exchange rate. So government sets the currency value against another currency or a basket of currency. Example, countries like Saudi Arabia peg their currency to the US dollar. Third comes managed float. So it's a hybrid system where the currency is allowed to float, but the government intervenes or intervention as needed. Example: the Reserve Bank of India (RBI) may intervene to stabilize the rupee if it fluctuates too much. So if there is much fluctuation, much price high and price low, RBI may intervene and try to manage the rates if possible. Then comes nominal and real exchange rates. So nominal exchange rates, it's the actual rate at which currencies are exchanged. And then comes real exchange rates. So real exchange rate means it's adjusted for difference between countries, indicating the purchasing power of one currency against another. So here is an example for how to calculate a real exchange rate. So nominal exchange rate, how we can calculate a real exchange rate, that is nominal exchange rate multiplied by domestic price and divided by foreign price. Example, if 1 USD or United States dollars equal to rupees 75, that is the nominal rate, then and the price level in India is rupees 100 while the price level in the US is 120, then the real exchange rate would be 75 divided by 100. I think there is some error, I will correct it, divided by 120, so it comes to 62.5. So the real rate ignoring the inflation effect is 62.5 rupees. Then comes the foreign exchange market. The foreign exchange or forex market is where currencies are traded. Major participants include commercial banks, central banks, brokers and traders. So the exchange rate in this market is determined by supply and demand. Spot market. So immediate exchange of currency at current rate or the rate which is prevailing. Then comes forward market. So here currency is exchanged at a future date at a agreed upon rate used for hedging against fluctuation. Then comes determination of nominal exchange rate. So nominal exchange rates are determined by demand, import, investment abroad, and supply, that is export, foreign investment in domestic market of foreign currency. So example, if demand for US dollars rises in India due to increased imports, the rupee depreciates, raising the nominal exchange rate. Then come changes in exchange rate. So you might have depreciated or appreciated. So what is it? So example, depreciation. A currency loses value relative to another currency. Example, if the India USD rate goes from 70 to 75, the rupee has depreciated while the dollar has appreciated. Similarly, I use the same example, appreciation. A currency gains value relative to another. Example, if we consider the same rate, if the India USD rate goes from 75 to 70, the rupee has appreciated. In first case, USD has appreciated. In our second case, rupee has depreciated and USD has appreciated. Then comes devaluation, that is revaluation and depreciation or appreciation. So devaluation or revaluation, it occurs under a fixed exchange system and it is an official government decision to adjust the currency value. Example, China has historically devalued the yuan to boost exports. Depreciation or appreciation, so natural changes in a currency based on market forces in a floating rate system. Then comes impact of exchange rate fluctuations on domestic economy. First is trade balance. So depreciation makes export cheaper, potentially increase demand and boost export while making imports costlier. Second comes inflation. So depreciation can lead to inflation by increasing the cost of imported goods, especially raw materials. Third comes foreign debt. So depreciation increases the rupee cost of repaying foreign loans, affecting companies and government finances. A numerical example for rate: if the exchange rate changes from rupee 70 for 1 USD to rupee 75, an Indian importer would now need 75,000 to import goods worth rupees 1,000 USD, up from 70,000. So here is the cost increase. So the costlier imports will reduce disposable income and impact purchasing power. So here is the cyclical impact of it. Then comes MG extras. So first is exchange rate calculation. So track a daily INR USD exchange rate for a week and calculate the impact of changes on a hypothetical import cost of say 1000 USD. Second, market simulation. So research how a specific industry like electronics is affected by the rupee depreciation and how it impacts local production. Then comes to the conclusion. Understanding exchange rate dynamics is essential for analyzing global trade and economic health. Changes in exchange rate impact inflation, trade balance, and economic growth, while currency fluctuations playing a crucial role in international economics. A grasp of these concepts aids in making informed decisions, especially in an interconnected world. So that's it from this video. Thank you for watching. Keep learning, keep growing, and keep rocking. Bye bye.